So like I said, in our last class, we completed the B and C. So today we are going to briefly work out the number D as well as the E. Then thereafter, we move to a new topic. All right. So in the D part of the requirements, D1, you are required to explain the meaning of shadow price and comment on the usefulness of it and its limitation. So you already have this in your notes. You know what shadow price is all about, which represents the extra contribution derivable from the additional unit of limited scarce resources that have been fully utilized at the optimal level of activity. Generally, any binding constraints are the one that we have shadow price, which means that at optimal level of activity where the decision is made, where you have your optimal production plan achieved, that is where you are going to have the shadow price. Every other equations you have there that is not at the optimal level will only resort to zero contribution. So it is only at that optimal level that you can get extra contribution. So I will not dwell so much on the D1, which are written, so they are in your material. Then number D2, you have to calculate shadow prices of the constraint. All right. Therefore, let's go back to our notes. We want to calculate shadow price of the constraint. That's number D2. Then number E1. Number E, you are told that assuming the company's position in C, the C is where you have your optimal level of activity, where you have your total contribution. So you are now asked to assume the company's position in C is maintained for 3 years with an investment cost of 45 million naira on the day of the commencement of manufacturing business, using a cost of capital of 15%. E1, can this venture be justified for the period? So examiner has given to you initial outlay. Initial outlay is the amount you are going to incur to start the project. All right. Then you are also given useful life of 3 years. Okay, you are given useful life of 3 years. Then you are also given cost of capital. Examiner has given to you the variables for calculating net present value. Therefore, you need nobody to tell you in this E1 that you are supposed to calculate the net present value, because when you want to determine the financial viability of a project using NPV, there are 3 variables that must be present. 1 is relevant cash flows. 2, appropriate cost of capital. Then 3 is the useful life. All the variables we are looking for are in this question. So in that E1, you are supposed to calculate NPV. When we get there, you see. Then E2, examiner is asking, what is the break-even discount factor for this project? So when you talk about break-even discount factor, it simply means internal rate of return, because another name for internal rate of return is the break-even rate, because internal rate of return is the rate that equates NPV to 0. So which represents the break-even rate, or due to maturity or market discount rates. So when we get there, I will show you how you are going to calculate that. All right, so but for now, let's go to D2, which is to calculate shadow price without wasting time. Let me share my working note with you. Notes. No, let me go back to the working notes we had last week, so that we continue from down. Working notes, program. Yeah, let's take it from where we started last time. Let me know if you can see my screen, please.
Yes, sir.
Yes, thank you. So this is where we stopped in our last class. So, um, okay, this is, we did determine contribution here. Optimal, yes, no. Okay, let's go back. Please, I need you to open to the material so that we can be talking on the same page. So number D2, you have to calculate shadow prices of the constraint. So to calculate shadow price, based on my explanation on the first day under linear programming, I said shadow price can be calculated using either dual method or increase the number of constraints by one. So whichever of the two that you use, that you are going to arrive at the same answer. But the issue is that one is easier than the other and one is shorter than the other. When you use dual method, that one is more straightforward. When you use increase the number of constraints, it will take additional steps for you to be able to get the shadow price. But all in all, you are going to arrive at the same answer, irrespective of the method you use to calculate your shadow price. Therefore, but as far as this question is concerned, since we calculated the the constraint was just on the matching hour. So it's only matching hour that is a constraint. So, and it's only one equation, not up to two. Since it's not up to two, we cannot use dual method to calculate your shadow price. Either you are supposed to increase the number of constraint by one. So, but let me take you back to what we did last time. Let me go back to yeah. Last time, you remember when we were solving, we said that, let me, yes, when we were solving for number C, our production plan, when we did our allocation, our production plan, we had to produce 150,000 units of biggie, then 100,000 units of smallies. This represents our production plan. It is this production plan that will maximize the total contribution of the organization. Therefore, in this particular requirements, examiner is asking us to calculate the shadow price. You can see that, okay, I will then say, I will say, which one am I sharing? Just want to be sure that I'm sharing the right. Okay. Yes, we're still on the question of what's the name of this company again? Yes, In terms Manufacturing Company Limited. That's the name of the company. So with this, number C, calculating shadow price. So for us to be able to calculate the shadow price, you go back to the question, to your notes, where you have determined the optimal production plan. Product B, sorry, Biggies. Biggies requires 200,000 units, but only 150,000 units were produced. Products Smallies requires 100,000 units, and then the entire 100,000 units have been produced. Therefore, it is only products Biggies that do not have sufficient matching hour to produce. Therefore, that is where you have the constraint. And because it is just only one equation, so there is no need, you cannot use dual method. Rather, you are going to increase the number of constraints by 1. Therefore, what you are supposed to do is that since the constraint of Biggie, the total requirement, the total labor hours for Biggie is 600,000 hours. Therefore, you increase that 600,000 hours by 1. That will be 600,001. Then you now divide it by matching hour per unit of Biggie, which is 4. So it will now give you, I think, 150,000.25. Now, this is what we are saying. Let me put it down for you. The total will require units. You require units of products of biggies. We require unit of biggies of, let me reframe that. Products biggies requires 200,000 units, but only 150,000 units were produced due to insufficient matching hours. Okay, with insufficient matching hours of 600,000. Whereas Rhodos Mollis requires 100,000 units. And the entire, whereas Rhodos Mollis requires 100,000 units. And this have been fully satisfied. And this have been fully satisfied at how many hours do we need for biggies? How many hours of biggies? Let's confirm. Biggies. We calculated how many total hours for biggies. Let me see. 600, no, for small is 200,000 hours. At 200,000 matching hours. Okay. However, therefore, to determine the shadow price, the $600,000 hours of Biggie will be increased by 1. Will be increased by 1 and determine the associated contribution margin from the equation. This is shown as follows. Okay? Now, this is what we are saying. When you look at, if you go back to the notes we had last week, you will see that the total requirement for Biggie requires 800,000 hours, but we only allocated 200,000, we only allocated 600,000 hours. So we cannot fully satisfy the total demand of Biggie because Biggie requires 200,000 units. We were only able to produce 150,000. Therefore, there is a constraint under Biggie. So in order to determine the shadow price, the constraint of Biggie, which is 600,000 hours, we are going to increase it by 1. Then to know how many units we are going to produce with 600,001, so we divide it by hour per unit, which is 4. So whatever we have, then we now multiply with contribution. Now, this is what I'm trying to say. Therefore, I want to determine number of units to produce with Biggies. Like I said, for Biggies, we have constraint of 600. That 600, you are going to increase it by 1. Therefore, this will now be 600,001. All right? So this is hours. 600,001 hours. So with this, then hour per unit, matching hour per unit is 4. Let me write that. Increase matching hour of Biggies by 1, which is equal to 600,001. Then matching hour per unit of Biggie equal to 4 hours per unit. Therefore, the unit to be produced with these increments, I would then say units will be equal to 600,001 divided by hour per unit, which is 4, equal to, what do you have there? 600,001 divided by 4. That's 150,000. 150,000.25 units. So this is what we are going to produce now. So with this 150,000.25 units, I need to calculate my contribution margin. I would then say new contribution margin. New contribution margin would then be for Biggies. 150,000.25 multiplied by contribution per unit of biggies. How much is contribution per unit of biggies? Hello, guys. Are you there? Hello?
106, sir.
106.
Bring my calculator. Bring my calculator.
106. Then for smallies, we are producing 100,000 units multiplied by what's contributions of smallies?
Who take it now?
94.
What's contribution of smallies?
94.
94, 94.
Stop it.
So I know this one to be 94, 9,400,000. Then what's 150,000.25 multiplied by 106? Yes.
50,900,000. 26.5.
50,900,000.
026.5.
026.5. Okay. So when you add it up, so this will give us 25,300,026.5. So this represents the new contribution margin. So for us to get the shadow price, we need to determine the current contribution margin. So the current contribution margin, where you don't have shadow price. So for biggies, we said we want to produce, our production plan is to produce 150,000 units of biggies at 106 naira. Then smallies, we are producing 100,000 units at 94 naira. So what's 150,000 units multiplied by 106? Yes?
50,900,000.
50,900,000. So when you add it to this, that's 25,300,000. So this represents the current contribution margin. Current contribution margin. So you need to compare this. This minus the revised, what did I write there? New margin. Contribution. So to now get the shadow price, I would then say shadow price. So I will pick the new contribution margin, which is 25,300,000 and 26 naira 5 kobo. I will less the current contribution margin of 25,300,000. So whatever difference I have thereafter will represent the shadow price, which is 26 naira 5 kobo. This is the shadow price. We said that shadow price is the extra contribution derivable from the additional unit of limited scarce resources that have been fully utilized at the optimal level of activity. This is the extra contribution we are talking about that is derivable from this allocation. So this is what examiner wants you to do. So, and that's that. I think that's 7 marks this year, 7 marks. So without wasting more time, let's go ahead and solve for, let's solve for E. So in the E part, you have to calculate NPV. What examiner is asking you to do for E is to calculate NPV. Therefore, I will then say calculating net present value. E1. Calculating net present value. Like we did previously. Like we did previously, to calculate your NPV, create a column for year, description of items, cash flows, discount factor, ads. I will go back to the question. What's the cost of capital given to us? Examiner wants us to use 15% cost of capital, and the useful life of the project is 3 years. Therefore, 15%, then present value. If you like, you can restrict your number to millions or to thousands. Okay? So year 0, initial outlay. We are told that the company will spend 45 million naira. Yeah, with an investment cost of 45 million naira on the day of the commencement of manufacturing business. So 45 million naira is the initial outlay. So I will come here, 45 million. Discount factor at year 0 is 1. 1 multiplied by 45 million, that's 45 million. The useful life of this project is 3 years. And examiner is telling, you can see in the question, you are not given cash inflow. You already determined, you are the one that will determine the cash inflow yourself. We've already done that. Our cash inflow is the current contribution margin of 25,300,000. So for year 1 to 3, annual contribution of 25,300,000. So we need to calculate annuity factor of year 1 to 3 at 15%. You bring out your calculator. You already know the formula for calculating annuity, because our cash inflow of 25,300,000 naira is constant. Year 1, 25,300,000. Year 2, 25,300,000. Year 3, 25,300,000. So it's constant. Instead of you listing them year 1, year 2, year 3, just calculate annuity factor and multiply with the cash inflow to get your present value. So that's what we want to do. So I can then say, let me just for your own sake, I will say annuity factor, AF. AF equal to 1 minus 1 plus R. Let me write that. 1 plus R raised to power minus N, all divided by R. R is the cost of capital of 15%. N is the useful life of the project. Therefore, 1 minus 1.15 raised to power minus 3 divided by 0.15 equal. Then you bring out your calculator. Let's do it together. 1.15 raised to power 3 minus equal minus 1 equal divided by 0.15 equal 2.283. 2.283. Please use your own calculator and ensure that you got 2.283. So here is 2.283 83. So I need to multiply that with 25,300,000. So I would then say 25,300,000 multiplied by 2.283 equal 57760. Here is 57760. So I will then find the difference. The difference should be 12,760,000. 12,760,000, yeah. So this represents the next present value. That's that. So with this, I will then move to C2. Let me confirm that number. Okay, minus 45. 12,760, correct. So E2 is saying we should calculate internal rate of return. Okay, you are required to determine break-even discount factor for the project. Like I explained to you earlier, break-even discount factor is the same thing as internal rate of return, because internal rate of return is the rate that equates NPV to 0. So another name for internal rate of return is break-even rate, or due to maturity, or market discount rate, or nominal discount rate. All right. So whatever name examiner has used is the same thing. But in this case, we want to calculate internal rate of return. So when you want to calculate internal rate of return, there are 3 procedures you are supposed to carry out. The first procedure is for you to assume 2 discount rates that will produce 2 opposing NPV. One discount rate will give you a negative NPV. Another discount rate will give you a positive NTB. Then we now proceed to calculating internal rate of return using internal rate of return formula. Then step 3, you advise. But in this particular one, I'm not sure examiner asked us to advise. Let me confirm the requirement again. We are not asked to advise. We are only asked to calculate break-even discount factor. So without wasting more time on this, so I will then say E2, calculating internal rate of return. To get the internal rate of return, so like I said, we need to assume discount rates. I don't know the rates I'm going to assume. Let me design my table first. Therefore, I will say here, items, cash flows, discount factor at then present value. Okay, now, when you look at, before you assume, when you want to calculate internal rate of return, you must be very careful before you assume your discount rates, so that you don't just be doing iteration. In this particular question, you can see that our annual contribution is 25,300,000. When you multiply that by 3, that should be around 75,900,000 relative to the initial outlay of 45 million naira. So that means that our cash inflow of 75,900,000 is almost double the initial outlay. So if you assume a lower discount rate, you just be doing iteration. So what I will suggest we do is that we can start from, say, 30%. Let's see what 30% will give to us. Let's see what 30% will give to us. So year 0, 1 to 3, initial outlay, annual contribution. Here is 45 million. Here is 25,300,000. So at 15%, sorry, at 30%, here will be 1 at 30%. Here will be 45 million. Okay, so let's calculate annuity factor at 30%. Therefore, I will say 1.3 raised to power 3 minus equal minus 1 equal divided by 0.3 equal. That's 1.816. Here is 1.816. So when you multiply that by 25,300,000, so I will say 25,300 multiplied by 1.816 equal. That's 45,944. Here is 45,944. Okay. So when I minus 45,944 minus 45,000, so that I will have positive 944. So that means my NPV at 30%, my NPV is positive 944. Therefore, I need to assume a higher discount rate that will give me a negative NPV. So with this, I can then come here to assume a higher discount rate to get a negative NPV. So with this, anything from 32, we should be able to get a negative NPV. Okay. Right. Just want to design my table once and for all. So if that is the case, let's assume a higher discount rate, say 32%. 32%. I just hope this will not give a positive NPV again. All right then. So I would then say
Negative.
1.32 raised to power 3 minus equal minus 1 equal divided by 0.32 equal 1.766. 1.766. So 1.766 multiplied by 25,300 equal 44,680. Here is 44,680. Here is 45,000. So the difference is 320. 320,000 is the difference. So if that is the case, we then calculate our internal rate of return. This is negative. We assume 30%, we have a positive NPV of 944,000. We assume a higher discount rate of 32%. We got 320,000 naira. Therefore, at this point, we need to calculate IRR. I would then say IRR equal to lower discount rates plus net present value of the lower discount rates divided by net present value of lower discount rates plus net present value of higher discount rates. All of this multiplied by higher discount rate minus lower discount rates. So IRR will then be equal to A is the lower discount rate, which is, we assume 30 and 32, so 30% is lower. So I will say 30 plus NPV of that 30 is 944. Divided by 944 plus 944. plus NPV of higher discount rate of 320. Multiply by higher discount rate of 32% minus lower discount rate of 30. So I will then bring out my calculator to say 944 plus 320 equal 1264. Therefore, 944 divided by 1264 equal multiply by 2 equal plus 30 equal. Here is 31.5%. Here is 31.49. My IRR equal to 31.49%. IRR is approximately 31%. That's that. This is what the examiner wants you to do in the E part of the question. All right. So let me know if you have any question for me so that we can move to the next one.
Sir.
Yes, talk
Good
to
evening,
me,
sir.
please. Good evening. How are you?
I'm fine, sir. So the IRR,
Yep.
do we have to assume for the two rates, or we can make use of the 15% that was originally given from the question as a basis, then assume the higher rate?
No, that is not IRR you are calculating. You know, that's the way we are being taught that, but that's not the way it should be, you know. So it's not compulsory that you must use the existing, if you have calculated NPV previously, so it's not compulsory that you must use that particular NPV that you have calculated initially for you to be able to get your internal rate of return. What is important is that when you want to calculate internal rate of return, you are expected to assume two discount rate that will produce two opposing NPV. However, if the first NPV you computed is appropriate for you to use, then we can use it. But what is important is that you are the one that will assume the two discount rates for you to be able to compute your internal rate of return. You can see this one we use 15% to calculate the NPV. We got NPV of 12,760,000. The difference, and what that means is that you have to increase from 15% to almost 32% for you to be able to calculate your internal rate of return. You can't, that increase in rates is not achievable it's not attainable in the market. It's not the highest. You should increase the difference between the two discount rates should not be more than 5%. So if you are now doubling your initial, initially you assume 10%, then you now increase it to 20%. Okay, you now increase it to 20%. This kind of rates is not attainable in the market. But because of at this level, examiner can pardon you. Okay, examiner can pardon you. But once you get to professional level, you have to use the appropriate discount rates. But in any case, from 15% to 31% or to 32% is too wide of a margin. So, but if, for example, you assume 20% and that 20% is negative, then you can use the existing NPV that you have calculated previously as your second discount rate for you to be able to calculate your internal rate of return. Okay, Sam.
All right, sir. Thank you, sir.
You are welcome.
Yes, sir,
So
I have another question.
yes, talk
Sorry,
to
sir.
me.
The second question is, that shadow price,
Yep.
you know, you said we can use either dual method or
Mm-hmm.
increasing. Yeah, assuming we have two constraints and we want to use increasing machine hour plus one, the one you said, increasing number plus one, or increasing by one, understand?
Increase the
So it
number of
means that
constraints.
increasing the number of constraints. So it means that are we going to calculate it to each constraint? You know, dual will be two. Assuming we are dealing with linear programming now, you know it will be two.
Yeah.
Okay.
You know, my explanation was that I explained it last time. I said that when you want to calculate shadow price using increase the number of constraints by one, what you are supposed to do is, number one, you identify the the constraint, you identify the point of intersection at the optimal level of activity. So you identify the equation that intercepts at that level of activity, optimal level of activity. Then you now increase the number of constraints by 1. You are going to be doing it separately. Say, for example, let me quickly do this. Say, for example, you have labor, you have material kilogram. The total material kilogram is 500. Then you have labor hours, which is 300 hours. This is maximum capacity available. So in this case, when you want to increase the number of constraints by 1, say, for example, material, you now have the first equation. For example, the first equation, you have, let me do it this way. We have 5 of A plus 3 of B equal to 500. Say this is equation 1. Remember, material is a constraint in the first one. Then in this second one, you have 7A plus 2B, for example, equal to 300. This is equation 2. So let's say these are the two equations that intercept at that optimal level of activity on your graph. Are you getting me, Samuel?
Yes, sir. I'm with you.
So with this, what you are supposed to do is you then want to increase the number of constraints by 1. So the first constraint, which is 500, I will then say 5A plus 3B equal to 501. Are you there? Equal
Yes,
to
sir.
501. So you then say 7A plus 2B equal to 300. So you now solve using simultaneous equation. So what are you supposed to do? In this case, we then say 7 multiplied by the first equation, 7 multiplied by 5A plus 3B equal to 501. Then 5 multiplied by the second equation, which is 7A plus 2B equal to 300. You solve, you get your simultaneous equation. Okay? So once you get your simultaneous equation, then of course you now multiply with contribution per whatever units you have, you multiply with your contribution per unit. Okay? You multiply with your contribution per unit. So you keep it on one side. That means you have gotten the shadow price for the first constraint, which is material kilogram. So when you want to solve for the other one, when you want to solve for the second constraint, which is labor, in this case, I would then do the same thing as you have done here. So in this case, all you are going to increase, you then say 5A plus 3B equal to 500, or you can start with the second constraint. It doesn't matter. Then I can then say 7A plus 2B equal to 301. You see? So you solve again using simultaneous equation. Once you are done with your simultaneous equation, then you calculate your contribution. So the difference between your new contribution margin and the current contribution margin will give you your shadow price. So that's how you are going to calculate shadow price for each of the constraints using increase the number of constraints by 1. All right?
Yes, sir.
So let's move to CVP. Let me stop sharing.
Hello, sir. Good evening.
Good evening.
Okay,
What? Who is speaking?
Chidemma, sir.
Okay.
See, I was really having that difficulty concluding this Oshimiri. I'm really eager
Oshimiri.
I'm
So
really
you
eager
could,
to know the outcome because I couldn't. I tried, so I've been waiting for you to start it. So
No
I said
worry.
to send us the solution later, but I really want to know the steps because I saw a similar question in one of the textbooks I'm using. That performance management made is by what is this man's name? I say a similar question, but I don't even understand their workings there.
No
So
worry, you'll be fine. All right? No need to worry.
I'm ready
I
for
will
it.
show you the
The workings.
I will share the solution with you. All right?
Okay, okay, no problem, sir. Thank you.
Okay, so let's go to the topic of the day. Which one is this? It's not what I want to. Okay, this is it. All right. Can you see my screen? Cost volume profit analysis.
Yes, sir.
Okay, then. So let's put on a short note, please, because of time. Let's put on a short note. So first thing first, before you put down any notes, you need to understand that cost volume profit analysis is a very practical concept. It's a very practical concept in that at times a company may need finance for a project, and if that finance is not readily available, the company may approach lenders or investors for the purpose of sourcing for funds. So one of the requirements, one of the things that your lenders or investor may ask of you is your business plan, because your prospective investor or lender will want to see how you are going to generate revenue, especially what are the sources of your revenue. Then how will you be able to pay back, especially the interest elements of the loan that you want to borrow. Therefore, in that business plan, you are supposed to provide a short-term financial summary. Like, for example, 1 year financial 12-month financial summary, 3 years financial summary, and the 5 years financial summary. So you need to demonstrate to the prospective investor that you are going to run the business profitably, and also you have capacity to repay both the interest and the principal sum at the maturity date. Therefore, if, of course, your business plan will show the financial summary, your performance for that period that you have estimated in the plan. For example, in 1 year, in that 1 year, your prospective investor would like to see what is your bottom line, what is your performance in the first year, what profit or loss do you intend to make. Then, not only that, what if market condition prevent the company from achieving its targeted goals? So what that means is that you need to calculate break-even, you need to determine break-even points that, okay, worst case scenario, if I don't make profit, I should be able to recover the amount I've spent. Okay, so that is break-even, because break-even is a situation whereby total revenue will equate total cost. So all those scenario analysis will need to be inputted or incorporated in the business plan. And that's what I'm saying, that in real life, okay, practically, the knowledge of cost volume profit analysis is essential for a professional accountant, because you never can tell where that information or that knowledge will be needed. And that's why at all time you need to ensure that as a professional accountant you have deep understanding of how to estimate the concept of break-even analysis. Okay, the concept of break-even analysis, both for the perspective of a manufacturing company and also a service company. But that notwithstanding, let's go to the let's dive in straight to discussing CVP. So remember, in one of our previous classes, I explained that marginal costing technique is a concept that is designed principally to aid management in making managerial decision. So marginal costing technique is used for managerial decision, and then also demonstrated for you the areas where you can apply marginal costing concepts. Number one area I mentioned then was deleting of a segment. 2, make or buy decision. 3, acceptance or rejection of a special order. 4, shutdown of capacity. 5, pricing decision. 6, optimal product mix. 7, linear programming. 8, CVP analysis, cost volume profit analysis. So those are some of the areas in which you can apply the concept of marginal costing technique to make managerial decision. All right. So when you now talk about cost volume profit analysis, it simply means the process, the application of marginal costing concepts, okay, to establish a relationship between costs, volume, and profits at different activity level. And then, of course, CVP analysis is also known as break-even analysis. When you talk about break-even is a situation whereby total revenue will equate total cost. That is a situation whereby a company will make no gain and then no loss. That is zero. You have a zero profit. When you have a zero profit, it means that you did not make any profit. So when you break even, what that simply means is that there will be no profits, no loss. But any points above your break-even points, if you go above your break-even points, it means that the company will be profitable. If a company goes below the break-even point, it means the company will make a loss. So that is just the introduction to CVP analysis. Now, how do you, the next area we need to talk about is contribution margin. Let's talk about contribution margin. Contribution margin represents the difference between total sales and total variable cost. It is also the difference between selling price and variable cost per unit. It also represents, contribution margin also represents the sum of profits and fixed costs. Okay, so that is contribution margin. Then how do you then calculate contribution margin? To get your contribution margin, just like I have defined it, contribution margin is calculated as total sales minus total costs. Okay, contribution margin is calculated as total sales minus total variable costs. So that will give you total contribution margin. Then you can also say contribution per unit equal to selling price per unit minus variable cost per unit. Okay. So selling price per unit minus variable cost per unit. If that information is not available in the question, then examiner must give to you profit and fixed cost. Therefore, to get my contribution margin, I would then say fixed cost plus profits. You remember when we did when we did operating statements, we have sales value, you less variable costs from your sales value. Then you have your contribution. Using marginal costing approach, you have your contribution margin. So from this contribution margin, you less your period cost. Under your period cost, you have your fixed cost. You have your fixed cost. Then we now said, of course, marginal costing technique is an accounting system where the period costs incurred are written off fully from the aggregate contribution. So this is our contribution. fixed cost is deducted from aggregate contribution to get profit or loss. So this is the profits. So when you now want to calculate contribution margin, we said contribution margin is sales or selling price minus variable cost, or profits plus fixed cost. That will give you contribution margin. So it depends on the information you have in the question. So whatever the information you have, you should be able to compute your contribution margin. Then that will take us to contribution margin ratio. Contribution margin ratio is also known as profit volume ratio. Profit volume ratio, which represents the ratio of contribution to sales or ratio of selling contribution per unit to selling price per unit. So how do you then calculate your contribution margin ratio? Depending on the information you have in the question, if you are given total contribution in the question, then total contribution divided by total sales will give you your contribution margin ratio. If in the question you are given selling price and variable cost, then contribution margin ratio will represent selling price minus variable cost per unit divided by selling price. Okay? So which will then be contribution per unit divided by selling price per unit. Then, of course, if you are given total sales in the question, contribution is not given to you, but you can see total cost. We can see total variable cost. Then the difference between total sales and variable cost will give you total contribution. Then total contribution divided by total sales will give you contribution margin ratio. So it is also possible in the question, all the variables you have up there are not given to you. All of these ones, you don't have the information. But in the question, you can see total sales, you can see fixed cost, you can see profits. Then profit plus fixed cost will give you contribution, then divided by total sales. That will give you the contribution margin ratio. So this is how to calculate contribution margin ratio. Then after that, let's talk about margin of safety. Let's talk about margin of safety. Before we go to margin of safety, please, you need to form a note. You need to form a note on assumptions, underlying assumptions of CVP. You need to form a note on uses of CVP. Then you need to form a note on the limitation of CVP. So those are the three elements I need you to write. I mean, to form a note on. It's an assignment. Please do form a note on that. I don't want us to waste time and be discussing all this written something you can just read it on your own. Once you read it, you have to understand it, then you jot it down in your own notes. All right, please, it's very important. Don't ignore them, because you never can tell where examiner will come out to you. So the last thing we are going to discuss after margin of safety will be the objective of CVP. We are coming for that. But for now, let's talk about margin of safety. So margin of safety represents the extent to which output will fall before a company begins to incur losses. All right. I repeat, margin of safety represents the extent or the degree to which output will fall before an organization begins to incur losses. That is what margin of safety is all about. And it is calculated as the difference between budgeted sales and break-even point of sales, or budgeted activity level and the break-even points in units. We can also say margin of safety is the ratio. Let me show you so that you can be reading through what I'm saying. Now, so like I said, when you want to calculate margin of safety, the budgeted sales will be given to you in the question. But this break-even point of sales, you are the one that will determine it. I will show you later on as we proceed how to calculate break-even point of sales. Now, this is if your margin of safety will be in sales What about margin of safety in units? So to calculate the margin of safety in units, it will be the budgeted units or budgeted output minus break-even points in units. So the difference will give you the margin of safety. It is also possible, examiner may want you to calculate margin of safety in percentage. Therefore, to get the margin of safety in percentage, then you pick the budgeted sales, you less the break-even point of sales, you divide it by the budgeted sales. Whatever you have at the end of the day must be in percentage. Okay? So this is how to calculate margin of safety. Now, and it's always very straightforward. Now, let's go to the objective. The objective of, there are 4 key objectives of CVP. The first objective of CVP, though it's up there, but I want to use the formula. Here we have, these are the objectives that you have here, but I want to write it down there so that I can use formula to demonstrate it for you. So in any calculation that you want to do under CVP, it is this, the requirement will come under this objective of CVP. Therefore, the first objective of CVP is to determine the units required, the number of units.
I can't see your screen, sir.
You can't see my screen?
Yes, sir.
Oh. Maybe I'm sharing the wrong. Okay. Let me stop sharing this. Please confirm. Okay, it's still loading. Confirm if you can see my screen now.
Yes, sir.
Okay. Then.
Margin of safety.
Yes, sorry about that. I thought I was sharing the right document. Okay, so this is what I was saying. To get when you want to calculate the number of units required to break even, that's one of the objectives, to determine the units required to break even. So this is one objective. The formula you are supposed, if examiner is asking you to calculate the units required to break even, the right formula to use, I would then say break even points in units will be calculated as fixed cost divided by contribution per unit. So I repeat, the first objective of CVP is to determine the units required to break even. Like I mentioned to you the other time, using the business plan in practice that you may want to insert, you may want to incorporate in your business plan the worst case scenario by break even, okay, by way of a break even, not making profit or loss. Therefore, you want to know, as a manufacturing company, how many units do you need to produce for you to be able to break even? When you break even, it means that you don't want to make profit and you also don't want to make loss. So for you to be able to calculate that, it is fixed cost divided by contribution per unit. This is one objective of CVP. Number 2, to determine, another objective is to determine the sales value required to break even. So that's another objective. This one can happen to anyone. It could be a service company, it could be a manufacturing company. You want to know how many sales are you going to generate in the market for you to be able to break even. So to do this, I would then say the right formula to use is you want to calculate break-even points in Naira. Therefore, it will be fixed cost divided by contribution margin ratio. So this is another objective of CVP. And I've also shown you the formula that you are going to use to get that. Number 3 objective is to determine the units required, the number of units required to earn a targeted profit. Previously, your intention is to break even. That is, you don't want to make profits. You also don't want to incur losses. But you may want to have a desired or targeted or intended profit. It is possible that, okay, you want to know as a management, I may want to know that how many units do I need to produce for me to be able to earn a targeted profit of 100 billion naira. Yes, I want to earn 100 billion naira. Therefore, how many units do I need to produce for me to be able to achieve that my targeted goal, my targeted profit? Therefore, the formula to use to do that is, you say break-even point in units equal to fixed cost plus targeted profits before tax divided by contribution per unit. So for me to be able to earn that 100 billion naira that I said, this is the formula I'm going to use. So to determine the units required to earn a targeted profit, it is calculated as fixed cost plus total targeted profit before tax divided by contribution per unit. Okay, profit before tax. Okay, so this is the formula that you're supposed to use. The last one, number 4, it is also possible to want to determine the sales value required to achieve a predetermined profits. So that is one objective, to determine the sales value required to achieve a predetermined or targeted profit. So to do this, you calculate your break-even points in naira will then be equal to fixed cost plus targeted profits before tax divided by contribution margin ratio. So these are 4 key objectives of CVP analysis and how to calculate each of them. But you have to note that the profit to use should be profit before tax. Okay? The profit to use should be profit before tax. What this simply means is that if you are given profit after tax, you need to convert it to profit before tax. I repeat, when you want to calculate break-even point to achieve a targeted profit, then that targeted profit must be profit before tax. So if you are given profit after tax, you need to convert it to profit before tax. So if that is the case, this is the formula. If you want to calculate break-even points to achieve a targeted profit before tax, if profit after tax is given, this is the formula you are supposed to use. So fixed cost plus targeted profit divided by 1 minus tax rates divided by contribution per unit. Okay, so to calculate break-even points in units to achieve a targeted profit where profit after tax is given, this is the formula you are supposed to use. The next one, if you are asked to determine the sales value required to achieve a targeted profit before tax where profit after tax is given, Provided it's sales value that you want to determine, then the right formula to use is fixed cost plus targeted profits after tax. In fact, this should be, let me rewrite this. Fixed cost plus targeted profit after tax. Because what is given to you in the question is targeted profit after tax. Then 1 minus tax rates, all divided by contribution per unit. So this is the formula you are going to use for that. Then in this one too, I would then say fixed cost plus targeted profit after tax divided by 1 minus tax rates, or divided by contribution margin ratio. You can see something is common in all the formulas I've demonstrated so far. Whenever you are required to calculate units, whenever you want to determine break-even points in units, your denominator should be contribution per unit. Whenever you want to determine break-even points in Naira, your denominator should be contribution margin ratio. I hope that is taken. All right then. So that's that. So at this point, let's move to multi-product break-even. Let's move to multi-product break-even. At least we should be able to solve one illustration under this today. Then in our next class we'll complete it. Now let's talk about multi-product break-even. Multi-product break-even. Now, the way you calculate break-even points for a single product organization is different from the way you are going to calculate break-even points for a multi-product organization. This is because for a multi-product organization, each product will have different selling price, different variable cost, and different contribution. So in that case, it will not be possible for you to be able to calculate the break-even points in units or in Naira for the entire for a multi-product organization, following the same procedures as a single product organization. Therefore, when you want to calculate, when the examiner asks you to determine the number of units required to break even or the sales value required to break even, or simply put, when you want to calculate break-even points, you need to find out before you begin to solve. You need to check from the question whether it's a multi-product organization or a single product organization. A multi-product organization is a company that produces more than one product. For example, a company can produce products A, B, and C, or products A, B, relative to the companies that produce just one product. All right. Therefore, how do you then calculate break-even points for a multi-product organization? So to calculate break-even points for a multi-product organization, there are 5 procedures that you are going to carry out. The first procedure is to calculate the overall contribution margin ratio. Okay, you calculate the contribution margin ratio for the entire organization. So in this case, the contribution margin ratio is not related to any product. Say, for example, a company produces products A and B. So when you want to calculate the overall contribution margin ratio, you are not using the contribution margin of each of the products. Rather, you are using the total contribution margin. So you are going to divide, in that case, you are going to divide, to get your overall contribution margin ratio, you are going to divide the overall contribution margin of the company. You divide it with the total sales of the company, which is not related to any of the products. So you keep it on one side. So that is first step. I repeat, when you want to calculate break-even points for a multi-product organization, the first step you need to do is to determine the overall contribution margin ratio. So your overall contribution margin ratio represents the total contribution for the organization divided by the total sales. All right, so you keep that on one side, then move to step 2. Step 2 says determine break-even point in Naira for the entire organization. Again, the break-even point in Naira does not relate to any products. It's for the company as a whole. Therefore, how do you determine the break-even point in Naira for the entire organization? The same formula you use to calculate your break-even point in Naira is what you are going to use in this case. All right. So remember, you want to calculate break-even points in Naira. So it has to be fixed cost divided by contribution margin ratio. All right. Then you then move to step 3. Step 3 says calculate profit to sales ratio, calculate profit to sales ratio, or simply put, calculate sales mix. Sales mix is computed by dividing the sales value of each product. You divide the sales value of each product with the company's total sales. All right. Let me demonstrate that. Say, for example, you have product A, product B, product C. Sales value of product A is equal to 500. Sales value of product B is 200. Then here is 300. Total sales value is 1,000. Therefore, for me to get my sales mix, if I want to calculate sales mix, to get my sales mix for A, sales mix for A will then be 500 divided by total sales of 1,000. This is going to be 50%. Then for B, it will be 200 divided by 1,000, which is 20%. For C, product C, 300 divided by 1,000 equal to 30%. So this is what is called sales mix. So it is this sales mix you are going to use. This sales mix in step 3 you are going to use to compute the break-even points in Naira, okay, for the purpose of computing the break-even points in units. So after step 3, you move to step 4. Step 4 says calculate break-even points in Naira. The break-even point in Naira will be determined by multiplying the sales mix in step 3. All the sales mix you have here, you use it to multiply the break-even point in Naira you have determined in step 2. That is, to get the step 4, you are supposed to multiply step 2 and step 3 together. Okay, for each product, you are going to pick what is the sales mix of, say, for example, in this case, the overall break-even point in step 2. The overall break-even point we calculated, say, for example, is 10,000 Naira. This is the overall break-even point in Naira. Therefore, using this hypothetical sales mix I have here, when I get to step 4, in my step 4, if I want to do for product A, I would then say 50% multiplied by 10,000 Naira. This will give me 5,000 Naira. For product B, I will say 20% divided by 10,000 Naira equal to 2,000 Naira. Product C, 30% multiplied by 10,000 Naira equal to 3,000 Naira. So I've distributed the break-even point in Naira for each of the products. Then for me to go to this, all what I have here represent the break-even points in Naira. Break-even points in Naira for each product. So for me to now get step 5, which is to calculate break-even points in units. So to get the break-even points in units, I'm going to divide the break-even point in Naira for each product. I will divide it with selling price of each product. So say, for example, selling price of product A. Selling price of product A, let's say this is selling price of product A is 50 Naira. Selling price of product B, for simplicity, is 20 or is 2 Naira. Let's say this is 5 Naira. This is 5 Naira. This is 2 Naira. Then this is 3 Naira per unit. This represents the selling price. So for me to now get the break-even point in units, so to calculate the break-even points in unit for each product, I would then say product A. For product A, I'm going to divide the selling price, the break-even points in Naira of 5,000 divided by 5 Naira selling price. So I'm going to have 500 units. I will do the same thing for product B. Break-even point in Naira of product B is 2,000. So I will say 2,000 divided by selling price of product B, which is 2 Naira. So this will give me 100 units. For product C, break-even point in Naira is 3,000. I will divide it by 3 Naira selling price. This will give me 300 units. So this is how you are going to calculate break-even points for a multi-product organization. Again, all of them you are going to use, you can use a table to compute for 4 and 5, to compute for step 4 and 5. You match step 4 and 5 together in a table. So this is the format of the table I provided for you here. So we go through that. I think we are done with all the explanations, all the concepts in of CVP analysis. Remember my assignment for you. Please go and read about the underlying assumptions of CVP, the limitations, okay, the applications of the areas of application of CVP analysis. Okay, so make sure you go through all of that. All right then. So if that is the case, at this point we can have a illustration. We still have about 30 minutes more. Before we have any illustration, please talk to me. Do you have any question for me? Any question?
Sir,
Okay.
good evening.
Yes, good evening.
Please, I don't really understand the difference between in the relevant formulas
Yep.
or break-even. I don't understand the difference between number 3 and number 5.
Between number 3 and 5.
Yes.
It's different. Number 3 is just to get the 6 mix. Because when you want to calculate break-even points for a multi-product organization, for a company that
Not
produces
this one, not this one. In the relevant formulas for calculating break-even.
in relevant formula of,
For calculating break-even, those formulas.
okay. Yes, you say you don't know the difference between
3 and 5, 4 and 6.
3, 4, 5, and 6. Is that what you are saying?
Yes, sir.
There is a difference. There is a difference. You can, even from the look of the formula, you will see that there is difference. Look at this one, for example, number 3, which is to calculate break-even points in units to achieve a targeted profit. Okay, break-even points in unit to achieve a targeted profit. So, in that case, like I said, the targeted profits must be profit before tax. So, in this case, it's supposed to be fixed cost plus targeted profit before tax. That's why I rewrote this formula here. Okay, fixed cost plus targeted profit before tax divided by contribution margin. Okay, divided by contribution margin. That's what you have here. Then in this number 5, I now say that because the targeted profit you are supposed to use, supposed to be profit before tax, targeted profit before tax. But at times, examiner will give to you profit after tax. So if you are given the profit after tax, you are supposed to convert it to profit before tax. And that is why you are dividing the targeted profit after tax by 1 minus tax rates. So the formula you have in step 5 is different from the formula you have in this number 3. You can see the two of them are different. In the number 4 is to calculate break-even points to Says if you want to determine sales value required to earn a desired profit. So in this case, I now said of course, if you are given profit before tax, therefore your break-even point in Naira to achieve a targeted profit before tax supposed to be fixed cost plus targeted profit before tax divided by contribution margin ratio. That's number 4, which is the main objective. Then in this number 6, I said that if profit after tax is given to you, because you need profit before tax, but if profit after tax is given to you, then this is the formula you are going to use to calculate your break-even points in Naira to earn a targeted profit. Okay? So there's difference between the formulas. Is it clear now, Pascal?
So the difference is that 3 and 4 is PBT, 5 and 6 is PAT.
Yes, that's just the difference.
Thank you.
Because the targeted profit should be profit before tax. But if you are given profit after tax, you need to convert it to profit before tax when you are calculating your break-even point to achieve a targeted profit. Yep. Okay.
Sir, sir.
Yes,
Okay,
talk
so
to
did
me.
this means that it's just like we are grossing up, that we are giving a net
Yes, of
amount?
course, you are grossing it, yes.
Grossing up. Okay, now I
Yes.
get, yeah.
So let's have an illustration. Let me see. Let's start small so that let's have the question to demonstrate the understanding of the concepts. Okay. Let's solve this illustration number 2 for a start. Illustration number 2. Let me see. Who came late today? When I was. Esther, read. Esther, you have been quiet these days. Esther, are you there? Hello, Esther. Okay. I'm not sure she's available. Yes, Grace. When I was greeting everyone, you are not available. I know all of you that came late. Grace, are you there? Grace. Grace, are you there? So some of you are purposely keeping quiet so that you don't want to read, right? No worries. Victor, you also came late. Can you read? Victor?
Which was Victor's?
Yes.
Okay. Marina Industries. Marina Industries sold 150,000 units of its products at 20 naira per unit. Variable costs are 15 naira per unit. Manufacturing cost of 12 naira and selling expenses of 3 naira. Fixed costs are incurred uniformly throughout the year and amount to 972,000 naira. That is manufacturing cost of 600,000 naira and selling of 372,000 naira. You are required to calculate A, the break-even point in units and naira. B, the number of units that must be sold to earn an income of 75,000 naira before income tax. C, the number of units that must be sold to earn an after-tax profit of 100,000 naira if the income tax rate is 40%. And D, the number of units required to break even if variable cost increase by 5% and fixed cost increase by 2.5%.
Yes. Thank you very much, Victor. Let me stop sharing this so that I can move to the working notes. So the name of the company is Marina Industries. So I will say Marina. That is illustration number what? Illustration number 2. Marina Industries. Number A requirements. You have to calculate break-even points in units and naira. So I will say A1 break-even in units. So break-even points in units is calculated as fixed cost divided by contribution per unit equal. I will then go back to the question, how much is total fixed cost? Total fixed cost is 972,000 naira. So here is 972,000 naira divided by contribution per unit. I will go to the question. How much is selling price? How do I calculate my contribution per unit? Examiner has given us selling price of, you are told that Marina Industry sold 150,000 units of its product at 20 naira per unit. Variable costs are 15 naira per unit. Okay, therefore, selling price is 20. Variable cost is 15 naira. Therefore, contribution per unit will be 5 naira. Final answer, 972,000 divided by 5 naira equal 194,400 units. So this is number of units required for Marina Industry Limited to break even. Then A2, A high, break even in naira. Break even in naira. So break even points in naira is calculated as fixed cost divided by contribution margin ratio. Fixed cost still remain as 972,000. 972,000, then divided by contribution margin ratio. The contribution margin ratio is calculated as contribution per unit divided by selling price per unit, which is equal to 5 naira contribution, selling price of 20 naira, which is equal to 0.2, 0.2, is it 0.2? Yeah, that should be 0.2. Let me rewrite that. Or 20%. Therefore, here will be 0.2. Yes, on the day of your exam, please don't go and be doing this. You can't be doing working under your main solution. You have to go and do your working separately on a different page. Please.
Sir, please, that's 0.25.
0.25. You are correct. Thank you. So please don't do this. Don't say this is the way Mr. Adejuwon did it and you do the same. Don't go and be doing this on the day of your exam. This is what I'm trying to say. So you need to go and work it out separately on a different page. Please don't do this on the day of your exam. Therefore, then 972,000 divided by 0.2 will give us 3,000,000 3,880,888,000. 888,000. Alternatively, since I already have break-even points in units, then I can say break-even points in Naira equal to break-even points in units multiplied by selling price. So the break-even points in units is 194,400, then multiplied by selling price of 20 Naira. You should have the same thing as 3,888,000 Naira. So that's that. So this is how to calculate break-even points in units and also in Naira. So let's go to number B, requirements. You are told that you have to calculate the number of units required or the number of units that must be sold to earn an income tax of 75,000 Naira before income tax. To earn an income of 75,000 Naira before income tax. So you want to calculate break-even point to earn a targeted profits before tax. So number B, so break-even number of units required to achieve a targeted profits before tax of 75,000 Naira. Therefore, I would then say break-even points in units equal to fixed cost plus targeted profits before tax divided by contribution per unit. Which is equal to 972,000 plus targeted profit of 75,000, all divided by contribution per unit of 5 Naira. I think, yes, it's 5 Naira equal. So I'll carry my calculator. 972,000 Naira plus 75,000 Naira equal 1,047,000 divided by 5 Naira equal 209,400. 209,400 units. So that represents the number of units required to achieve a targeted profit before tax of 75,000 Naira. So let's move to the next one. Number C, the number of units that must be sold to earn an after-tax profit of 100,000 Naira if income tax rate is 40%. So I would then say number C, we want to determine number of units to achieve a targeted profit, to achieve a targeted profit after tax of 100,000 Naira. So because examiner has given us targeted profit after tax, so we need to convert it to profit before tax. Remember, your targeted profit should be profits before tax. So if profit after tax is given to you, you need to convert to profits before tax when calculating your break-even point. So with this, I would then say break-even point in units will then be equal to fixed cost plus targeted profits after tax divided by 1 minus tax rates, all of that divided by contribution per unit equal Fixed cost is 972,000 plus targeted profit of 100,000 naira. That's targeted profit after tax. Examiner told us that tax rate is 40%. So we are supposed to account for 60%, 0.60. That is 1 minus 40% will give me 60%. So divide by contribution per unit of 5 naira. So final answer. I will then carry my calculator. 100,000 naira divided by 0.6 equal plus 972,000 equal divided by 5 naira equal 227,733. 227,733 units. So that is that. Let's move to number D. Number D, the number of units required to break even if variable costs increase by 5% and fixed costs increase by 2.5%. So if variable costs increases, then our contribution margin or contribution per unit will also change, because in this case, what we are supposed to do is to let's go and make adjustments, which is number D. I will call my number D. Number of units required to break even if variable cost increases by 2.5%. Let me confirm that. By 5%, then fixed costs increase by 2.5%. If variable costs increase by 5% and fixed cost increases by 2.5%. So what this simply means is that my contribution per unit will change. So as a result, I need to go ahead and calculate revised contribution margin. So for me to get the revised contribution margin, I must first thing first determine revised variable cost. But let me merge everything together in a formula. So my revised contribution margin contribution per unit. So contribution per unit would then be equal to, of course, selling price is 20 naira minus, we are now told that our variable cost will increase by 5%. The current variable cost is 15%, sorry, is 15 naira. Okay, 15 naira multiplied by, we are told that it will increase by 5%, therefore multiply by 1.05. So what do we have? 1.05 multiplied by 15. That's 15.75. So here is 15.75. Therefore, our revised contribution per unit will then be equal to 4 naira 25 kobo per unit. Okay. So we're also told that our fixed cost will increase by 2.5%. So I will say revised fixed cost. So revised fixed cost, we calculate the current fixed cost is 972,000. So we are told that it will increase by 2.5%. So multiply by 1.025. So what do we have here? 972,000 multiplied by 1.025 equal 996,300. Here is 996,300. So if that is the case, therefore, I will then go back here. the break-even points in units would then be equal to the revised fixed cost of 996,300 divided by the revised contribution per unit of 4 naira 25 kobo equal to bring out your calculator, divide by 4.25 equal. That's 234,424. 234,424 units. That's it. That's it. It's as simple as that. So that's end of the question. That's end of the question. Please confirm. Do you have any question on this question we just solved? Let's see if we can have one more illustration or we just postpone to the next time. All right.
Illustration, sir.
You have a question for me, right? Hello? Do you have a question for me? If none, then let's have one more illustration, please. Let me stop sharing this. So let's have illustration number 3. Different scenario. Let me know if you can see my screen. Victor, what are you saying? I don't understand this, your sign. What are you saying with this, your emoji? Anyway, don't tell me you are crying or you are not a baby. Oh, yeah. So who will read for us this time around? Your head is hot. Ah. Gabriel, it's 2 minutes. So you are saying that we should stop. We should end the class. Hey, there, Jonah. Hello, guys. Do you want us to end the class or we should just have one more illustration? Talk to me, please. Should we end the class or we have one more illustration? Spend additional 15 to 20 minutes more. You guys are not talking. Okay. Let's postpone, sir. Let's end. Lazy students. See, Yinka, now you have your voice. I've been calling you since to read. You did not talk. The same thing with Osana. Now you're asking me we should postpone the class. Don't worry. We are going to postpone. If that is the case, let's call it a day, please. I think majority have it. It's like, your head is hot. No worries. Okay, guys. Let me just inform you. Let me stop sharing first, then stop recording.